John, welcome to Toronto.
Great to be here.
So maybe if we could talk just a few minutes about John's personal path. If we can go from, 1992, you walk into Blackstone, and then 2005, you're the head of global. How the hell did that happen? You're an analyst. You've studied English literature, and you're running this huge group.
Yeah. Well, I'd love to say I had a master plan, and that's how this all came to be. That's definitely not the case. In fact, if you think about somebody who's going to run a global real estate business, they probably should have traveled to the East Coast of the United States before they were a freshman in college. They probably should have gone to Europe before their honeymoon when they were 25. So I had no idea this is where I was heading. But I've had a lot of good fortune along the way and a lot of great people who've supported me. Yes, I was in suburban Chicago. I went to the University of Pennsylvania, and that was really formative and fortunate because I got a dual degree. I got an English major, and I was in Wharton in finance. And what was key was in a 2-week period of time, my senior year in college, I met a young woman in romantic poetry class, and I got a job working for a small investment advisory firm. And 26 years later, I'm with the same woman. Our children are now in college, and I'm working for the same firm. So that was incredibly fortunate. I got a job going to work for Blackstone. Initially, Blackstone didn't have a real estate business. I went to the firm working in the corporate area, private equity and M&A, and what I found was I really enjoyed it. The firm trained me. I worked really, really hard. I was an analyst. I was making books and ordering dinner and all that stuff. What I got was great corporate training, which in retrospect proved very valuable as we evolved our real estate business into big public and to privates. But I think what was key was a year into it, the real estate market in the US had collapsed, and Pete Peterson and Steve Schwarzman, the founders of Blackstone, said, we want to go into this business. They got a couple of senior people, and somebody said, we need some junior folks. I was tapped on the shoulder, and I found myself in the real estate business.
So no master plan?
No master plan whatsoever.
Okay, so fast forward to 2005, and how big were you then?
So we work really hard. At the point in 2005 where I get the opportunity to run the business, we had about $5 billion in assets. Okay. And we were about the size of a bunch of our other competitors. At that point was really a key tipping point because we just got on the idea that the markets, as you may recall, Alan Greenspan had brought rates down really low. Prices in commercial real estate had been on a huge uplift really since the early 90s. Commercial mortgage-backed paper was coming out. And I had this idea that we could use commercial mortgage-backed debt to go buy public companies. And we could really expand what we were doing. And that was when the business really took a step function in size. We went from just buying individual assets or portfolios into buying very large public companies, which ultimately culminated with Equity Office for $39 billion in 2007.
Okay, so before we get to 2007, though, because the vintage 2007 deals are really worth talking about, I think what people want to know is, I've heard you often say you have to be a little bit crazy in this business. You're on planes all over the place. We're working fanatically. What is it you love about this business?
So, it's funny. You go back. We were talking about where I grew up. I think about at its core. I love the fact that it's a measurable business, a competitive business like sports. So, at the end of every investment, as folks in this room know, you could see, did I do a good job? Did I double your capital? Did I just return it? Did I lose it? And you have a track record. So for us, we've delivered 16% net returns for 26 years on $75 billion of invested capital. That's the thing we're most proud of delivering for our investors. So I loved the competitive nature. And then I love the Rubik's Cube part of it, right? Yeah. Which is, how do I think about unlocking an opportunity? How do I think about deploying capital in this country or this sector different than somewhere else? And then I love the people element. The people here, our dinner last night, the friends you make along the way. I've always loved it. And I would say being at a firm that has encouraged entrepreneurship and risk-taking, which I think is essential for any investment business, that's also been very special.
John, it's impossible to not go to one of your LP meetings and sort of not notice what would you say the average age is of the people that run your platforms?
Who
And
run
secondly,
the part?
can you just talk a little bit about the culture? You know, it's not just the asset base you
Yeah.
built. At the root of all that, when we visit, you can sense that there's a real culture that that has grown there. And just talk to us a little bit about your people. You know, where you find them and how do you retain them?
So to the age question, the folks who run acquisitions in most of the regions around the world are probably in their mid to late 30s. It's the nature of the job, which is they're on a lot of planes, and maybe there's only so long you can do that for. But I think what makes...
There's maybe only so long, what do you throw everybody out at 40?
No. But I was talking about the lead acquisitions person. But I would say that what makes it work is the fact that we're at a firm where we're constantly pushing and pressing people to think differently. That at the core, investing is about seeing things maybe in a different way than other people do and acting on that. And we've created an environment that really encourages that. And then we have a business that has grown. I mean, we talk about a business that managed $5 billion of capital in 2005 and manages $111 billion today.
U.S., you have to say U.S.
U.S.,
here,
sorry,
yeah.
U.S.
Right.
And if you put the debt on the properties, it's probably double that, $220 billion. And the growth of this business has created incredible opportunities for our young people because they've had the opportunity to cover a region, and then when we expand the business into debt, you know, somebody can go and do that. When we move into Asia, when we move into Core Plus, that growth has been really powerful and exciting for the people who work for us. The growth in the business has also allowed us to compensate our people in a really great way. There's just a sense at our place that we want to deliver the absolute best returns possible. We want to do the best job we can, and that there's always something more we can do. And that sort of energy flows through the whole business. It doesn't mean we're perfect. We certainly make mistakes. But I think it makes our young people excited because they realize there's something new we're going to do next year that they may have an opportunity to lead. And that allows you to attract and retain really great talent. And at the core of any business, everyone knows that those great people are the heart and soul of a business.
Well, what do you look for in those young people?
I would say the thing we look for the most, obviously you need people who are highly intelligent. You need people who work really hard and care a lot. So athletes are often great because you know they've gotten up early, they've sacrificed in their lives. Obviously, people who get great grades in school, you recognize somebody who's worked really hard. You also love somebody who has, as I said, a bit of a risk appetite. It's not enough to just be really smart with a computer. You want somebody who says, hey, U.S. home prices after the crisis have fallen 50%. We can go out and buy 50,000 homes and lease them out.
Right.
So you want people who have a willingness to take some risk.
Okay, so back to you. You've been named the head in 2005. Things are okay for the first couple of years. You do these mind-boggling deals, Hilton, Equity Office. And I just had a little quote here, being a history freak, comes from Abraham Lincoln. He says, "A compass will point you true north from where you're standing, but it doesn't tell you about all the obstacles, swamps, mountains, and deserts to get you there." So I was laughing last night thinking about our conversation, thinking to myself that I remembered very clearly. So now we've lived the last 7 or 8 years, the golden period. But you know, you mentioned to me one time not so long ago that you weren't really being asked to do any panels in 2007, 8, and 9. But so do you want to take us through the Hilton deal and just talk to us about the adversity that caused and maybe the results? The history of that deal, I think, explains a lot of things.
Well, I think like most people in the room, 08, 09, well, certainly more so in the U.S., Ireland, Spain, Australia, the downturn was very sharp. For us as a business, our timing was not perfect. In 07, we committed to 2 very large transactions. Equity Office was $39 billion, Hilton was $26 billion. Combined, we put up more than $10 billion of equity capital at, in retrospect, exactly the wrong moment. And so, as you point out, we marked down Hilton by 70% by the summer of 09.
Not a happy day.
Not a happy day. And going to investor meetings was not that much fun. But we had a view that we owned a great business, that global travel was something that would continue, that Hilton had these incredible brands that we thought could really grow around the world beyond Hilton, Hampton Inn, Homewood, DoubleTree, Waldorf, Conrad, and that growth story existed, and that the company, which had been sleepy, based in Beverly Hills, closing Friday at noon, with the right CEO, could really be energized, could grow a lot faster. And so despite the storm outside and how negative the world was, we stuck to our knitting. We actually bought some debt. We invested $800 million, which we committed at the end of '09, which seemed quite bold at the time. Most people might have said, gosh, shouldn't you just walk away from your losses and move on? But we believed in the business. And I think for me, fundamentally, trying to separate what the crowd's saying from what's actually happening was really important, and we didn't lose faith. And we reinvested, we stuck with the management team, the business kept growing. There was a cyclical recovery in lodging, not only in the US, but around the world. And we get to a point where today on that investment, it's become the most profitable private equity, real estate private equity deal of all time.
Well, just for the heck of it, why don't you just tell us what the mathematics are of that?
So the mathematics are, we ultimately invested $6+ billion. We made more than $14 billion. Yeah. Almost all of that realized. We just owned a very small piece of Hilton. EOP, which was similarly timed, we've also tripled our money on basically close to a $4 billion investment. In that case, we sold tons of real estate before the crisis. Yeah. What we held on to was in the very best markets. We reinvested, bought debt again, and we're patient coming out. And to me, the lesson is, if you own a great business or great real estate, if you can have the fortitude to stay through, if you have a capital structure that allows you to survive, that makes a huge difference, and you need to hang in there. And the people who got hurt were those who were forced to sell at the wrong moment, and we weren't. We stuck through it, our investors stuck with us, and it turned out okay. But that doesn't mean when I was in the swamp that I was feeling great.
No, you weren't feeling. And how long did that last, the swamp, would you say, 2 years?
I think the swamp lasted 2 years, and then the sun started to come back out, and we got to see. But what was interesting, I think, for most people during that period of time was they were so focused with dealing with their own problems, they forgot that there was great opportunity. So that's the other challenge when you're dealing with a crisis, which was, gosh, prices have gone, oh my God, I should probably stop and just focus.
Hit the panic button.
Hit the panic button, wait for some all clear sign. But as a real estate investor, when you can buy hard assets at a discount to replacement cost, which is our basic business model, you do that. So at the same time we were dealing with our legacy investments, we were pushing to invest to buy all sorts of assets here or in the United States and all around the globe and expand the business. And that was probably the biggest thing we did. And certainly seemed very risky at the time, but in retrospect, we were buying things very inexpensively, and was another important lesson, besides not losing faith if you own something really good, but when opportunity comes along, even if you're dealing with other issues, don't forget to take advantage of it.
Okay, so just thinking about Blackstone's investment philosophy since then, seems to me that there are elements of that story, the Hilton story, that sort of permeate all through your deal making. The words that I used to hear, I was very envious because we'd spend weeks, bureaucratic weeks and months working out this beautiful strategic plan, which almost never really happened the way it was supposed to. And then I'd meet you and you'd say, well, listen, Danny, our plan is buy it, fix it, sell it.
That's it.
So go ahead. I mean, so it's buy it, fix it for a while, but it's evolved. So why don't you say the first part?
Well, I'll start with buy it, fix it, sell it. If you're in a business, it's always good to say, sort of what's your mission? And as I said, our mission is buying hard assets at a discount. So how do you do that? You deal with distress. If prices are down in Spain,
you better watch it with the discount. There's people here that actually sell things once in a while.
Yes.
So they'll never talk to you about a sale if you keep going.
But I want to try to find a way, either through public companies, either through debt and distress, complicated partnership. Is there a way I can get in an asset? My favorite example, we bought the Cosmopolitan Hotel and Casino in Vegas, which I recommend you all visit. It was built for $4.3 billion. Very bad timing during the crisis. We were able to buy it for $1.7 billion. It has turned out to be an excellent investment. We've grown cash flows by more than double. That's what we like to do. Once you acquire the asset or the business, you fix whatever's broken. In the case of the houses we were buying in the US, we went and spent $25,000 a home to renovate them, lease them out, create a business. And then in our opportunistic business, where we're trying to generate very high returns, we turn around and sell. And what you're pointing out is we've expanded our business beyond just the opportunistic space into the core plus space, where we're buying very high quality assets in major markets, where we're buying, doing a bit of fixing, maybe not a completely vacant building, less risk, and then we're holding for a longer period of time. But the investment thesis of trying to buy hard assets at a discount is the same.
So you have a mind-boggling research capacity. You know, you've got a network that's mind-boggling too. So you do this theme investing. Can you give us just a couple of examples of that, how that's evolved, and how you combine sort of all the, you know, you're such a nice guy. It's a little weird to see you smile when you say, you know, distress. Yeah. It seems to me to be a bit, you know, a conflict there, but maybe not. I think it's great. So give us examples of theme investing, because you've talked about scale, speed, conviction, and theme investing. And from what I've seen, those go in the major moves that you've made. Yeah. They seem to go together.
So I think conviction, you're definitely right, and scale. If you think about generating returns as you're deploying capital, the mistake I think so many of us make is we sprinkle money around and then we say, gosh, we're disappointed with the outcome. We don't have any particular expertise or insights, and it's very hard to generate alpha or outperformance without saying, I see something differently. So to us, you want to be a high conviction investor. What you want to do is say, I see global logistics different than everybody else does, given what's happening as a result of online shopping. We can come back to this. I see that differently, and as a result, I want to get a management team or a platform or a series of them geographically and put a bunch of capital behind that. Right. And we went out and bought 420 million square feet over the last 7 years of logistics assets around the world. And doing it in scale enables us, if we really believe in this and have expertise, to hopefully generate outsized returns. That's the basic thesis. And then for us, because we operate in large scale, being the folks who can show up at one time and say you're done is a huge competitive advantage. You know, when GE went to sell $23 billion of real estate, they said publicly there was only one person in the world we could call to do that. Right. That is a great place to be. So have conviction, operate in scale. For us, those are really important themes. And the themes have evolved. Obviously, after the financial crisis, buying London office buildings was a terrific theme, you know, at that point in the cycle. I talked about US housing, Spanish housing, which is a really compelling area. We continue to invest a lot of capital. We can talk about India, where we have been by far the biggest investor in office buildings there. We're constantly looking and talking about themes. One of the challenges of having a big investment organization, people always worry that when you get large, you're going to lose your discipline and you're just going to put out money in a very siloed way. And it's interesting because I think we have so many great processes, investment committee, review committee. My biggest concern isn't that we get reckless, it's that we lose that edge. It's the opposite, that we stop innovating, stop saying, oh my gosh, did we see this city? Did we see this asset class? Yeah. We went into the life science office business a year and a half ago, a company called Biomed. We bought an $8.5 billion public company. We didn't know much about that space, and yet what we discovered was, you know, there's a revolution going on in terms of life sciences demand, and you do it in a relatively small number of cities, like Cambridge, Massachusetts, South San Francisco, San Diego. And that supply demand dynamic is incredible, and we should really go all in this space. And so finding those themes, super important, and we can certainly talk about some of the things we're looking at today.
Yeah, okay. Maybe we could talk about two, we did one together, right? New York City affordable housing was your theme, and maybe we could just go through that. Maybe we have a little different versions of the same story, I'm not sure. But it might be interesting, you know, I from the institutional side, and you wanted to, you know, it's your city. Why don't you tell the story, and I'll try to see if I...
Well, it starts, I'll give you a couple things. So I called Daniel I guess it was 3 years ago now.
That's the
And
first lesson.
The first,
Doesn't
I
happen
called
overnight.
Daniel, I said, I have good news and bad news. I said, the good news is, I think we have the opportunity to buy the largest apartment complex in the United States, Peter Cooper Village, Stuyvesant Town. The bad news is we have less than 2 weeks to commit to the transaction. And Daniel laughed, thought I was joking, and I said no, and quickly said, look, we know the asset, we've looked at it, we can jump on this as well, we know New York City affordable, and we sort of jumped in this together. The one other side story I'll tell about it is, this asset has had a troubled history during the crisis, had been over-leveraged. It really had been a bastion of middle-class and affordable housing in New York City, and there was a lot of concern around that, so a lot of political focus on this asset. So when I told our political and press team I was looking at it, they said, no way, you can't touch this thing.
Well, we
It's
agree
too-"
on that one, because
Yes.
ours said the same thing.
You guys said the same thing, and I said, well, look, we'll do it, but we'll only do it if the mayor of New York, Mayor de Blasio, the local city council people and the tenant association are basically hugging us or supporting us. And our people were like, well, that's never going to happen, so you can go and work on this. And we set about saying this was a very complicated situation with multiple constituents. Let's figure it out. At its heart, we could buy great real estate at less than $500 a foot, and we could do something really socially good and preserve half the units in a long-term affordable program. And then beyond that, do a bunch of great things around sustainability, because it's really a special community. If you've never walked through it, when you get to New York, it's just an interesting oasis inside the city. So I'll let you tell your side.
I just think the lesson on our side, and I think we already knew it, but that really confirmed it. You're right, you know, what was it, whatever it was, 2 or 3 weeks. But the reason I laughed was because, hold it, John, it's not, for us, it's not 2 or 3 weeks, it's 10 years. We've underwritten it 3 times. We owned for a little while the special servicer that was doing it. We had an incredible team that had been doing rental investing in New York City in a company called Stonehenge. So all of our people understood New York City really very, very well. Enough to say to you, John, listen, governance boards, I got to do it all carefully, but we understand New York City, so I really have 3 questions for you. Do we have a deal with the most politicized group of tenants in America, including congressmen, mayors, everybody? Do we have Fannie Mae financing that's okay? And do we have a deal with the city? So, you know, to your credit and to your team's credit, and I don't want to rub this in, but the 4 people that were really involved at the beginning, I think 3 were Canadian.
Yeah.
Okay,
By the way,
so-
we have lots of Canadians who work for us.
but
I want
just
to tell
just
this.
to rub it
Our
in a
head
little
of
bit.
America's Investing, Nadeem Medji, is a Canadian.
No, so I started counting. I say, Farhad runs what now exactly?
He is our COO in Europe and our general counsel globally.
Okay, so Farhad is from Vancouver. Nadeem, who was the principal architect of that deal with Sylvain Fortier from our place, says they're very close. Where's he from?
Toronto.
He's from Toronto. Okay, where are you from? Okay, so that was 3 out of 4 Canadian content. That's not bad.
Yeah.
So anyway, what was perceived as being an ultra core deal, I think are giving us returns that are much better than that. But also we just announced a small thing about solar last week that got more New York City goodwill than I think we could.
Biggest New York City, I think biggest urban solar project in the United States. We have the benefit of all these flat roofs. So
Okay. John, I'm
anyway,
going to speed it up a little bit.
let's go.
I've checked with a lot of people. I have, from your friends, your colleagues, Inside Scoop, your 4 daughters are incredible. So they say about you, they're bragging, okay, that you're Snapchat friendly, you're Instagram friendly, and that unbeknownst to any of us, you can sing all of the top 40 songs and know the words. So I thought, well,
not so much.
hey, that's a little bit of a maybe embellishment. But anyway, you know that Adele song that we've heard a million times, is this the end? That's the question that people have been asking here and asking you.
Yeah.
So where are we on that? What do you see? What are the threats? What are the opportunities?
I think we're definitely in a more mature part of the cycle. I'm not telling anyone anything they don't know in this room. On the negative side, what you have is cap rates at very low levels, even lower here in Canada than the United States, but around the globe, cap rates as low or lower than '07. And why that concerns you is that interest rates, the great decline we've been watching for so long, seems like it's going to start to head in the other direction. You know, you've got the Fed in the US raising rates, the Bank of England raised rates for the first time in a decade, the European Central Bank saying it's no longer going to be expanding its balance sheet in the same way. Inflation in the US is, labor inflation is running close to 3%. And it's possible here, you've seen now synchronized global growth, which I'll come back to, but you know, it's possible we get a meaningful tax cut in the US as well, which is fiscally stimulative. I think that's going to lead to higher interest rates. So when you think about cap rates, that gets you a bit cautious because our collective cost of capital goes up. Also, as cap rates fell, fundamentals in most categories of real estate around the world during this great period have been pretty good. So cash flows have grown. And so the combination has meant asset pricing is up a lot. And I don't have to tell the people in Canada about that. And so you look at that and you say, gosh, maybe the Adele song is right. But on the flip side, there are some very positive factors. So generally around the world, demand and supply pretty good. You know, growth here is close to 3%. US growth, maybe 2.5%, Europe 2%, Japan 1.5%, China and India 6.5% plus. So the driver of real estate demand is pretty good. New supply coming out of the financial crisis in most markets is fairly constrained. So in the US, new supply is running around 1.3% against an economy growing almost double that. That's why you see rents and occupancies and cash flows growing. So the supply-demand picture is good, which is good for cash flow growth. Also, leverage, which is always our great undoing in real estate, is pretty constrained. I mean, the idea of the 99% buyers when we sold our New York City office buildings in 2007, that doesn't exist. The commercial mortgage-backed securities market in the US is off 2/3 from when it was in 2007. In Europe, it hasn't even come back at all. So debt's constrained. So the question is, if you put that together, where does it lead you? I think it leads you to believe that cash flows will grow, but cap rates are probably going to drift up a little bit, and overall value will grow, but at a much more modest rate. And so as investors, I don't think you can any longer sort of put your arms out and just hope it's going to work out. I think you have to be much more precise about where you deploy capital, much more focused in both the geographies and the sectors. So I still think there's room here in this cycle, but you have to be cognizant that we're probably moving into a higher rate environment.
Okay. What about tech disruptors? I've heard you talk about a lot where we work, where we live, where we shop, the same issues that we're all facing, but you've taken advantage of that in some areas. You're worried about others. What do you think?
So I think tied to my earlier comments, if you're saying, how do you want to deploy capital? I think you have to think about technology in everything we're doing. Even though we're in the real estate business, which is ostensibly the sort of old world business, tech is driving things here as it's driving every other industry. So how do you get a sense of how big tech is? The 5 largest companies in the world today, Facebook, Amazon, Google, Microsoft, all of Apple, these companies have seen their market caps grow from 1.3 trillion US to 3.3 trillion US in 5 years. These are enormous. Now you'd say maybe there's some giant bubble. Well, their sales in the third quarter were up 26%.
Right.
These companies are taking more and more share, and they're fundamentally, they and the other technology companies are changing things. And when you look around the world, and it's one of the great advantages of our platform, is we're seeing the same things. Wherever creative industries and tech industries are housed, we're seeing much higher population and job growth. And obviously, you're seeing it here in Toronto and Vancouver, but it says to you, gosh, I want to invest, sort of fish where the fish are. So I'm much more excited to invest in the West Coast of the United States, in Seattle, in Northern California, in San Francisco, in West Los Angeles, in Austin, Texas, in Cambridge, Mass, in Lower Manhattan. In Europe, it says, gosh, London, the Nordics, Stockholm, Amsterdam, Berlin, which is probably my favorite city in the world today. It leads you to Sydney and Tokyo and Shenzhen and Beijing and Shanghai. And it certainly leads you to India in a massive way. Because wherever you get tech and low cost, part of the reason Seattle is booming is because the rents are less than half of what you're seeing in San Francisco. Bangalore, they're a fraction of that. You know, we've seen more absorption in Bangalore, Hyderabad, and Pune, 3 cities you may never have heard of, than you have in the 6 largest cities in US and Europe over the last 8 years. So if you said, was there one guiding theme around tech that's impacting us, it's we want to invest in these major cities. There's a big urbanization trend, but particularly where creativity and technology are growing. Those are places you're seeing more job growth.
So the shared economy, supply chain changes, you're really long on logistics. You just did the Logicor, was that 14 billion or something?
So I'd say a couple things about the nature. One, in talking about the sharing economy, one of the big impacts of technology is, and it's been beneficial, part of the reason we haven't seen rates go up is the inflationary numbers are just not rising the way any of us expect. In fact, core CPI in the US is 50 basis points lower than it was the year before, which is totally counterintuitive. Why? I think tech's the reason. So the sharing economy, when Uber adds all these cars out on the road, what does it do to taxi rates? What does it do to Hertz and Avis? Parking rates, highly deflationary. Airbnb adding capacity in the lodging sector. When you think about the supply chain, and I'll come to Logicor, in the old days there was a company who produced a product here or service, and there was a consumer. And in between, there was somebody who charged a lot of economic rent for shelf space. They were a media company, like a cable company, a movie company, a retailer. That's being disintermediating, again, highly deflationary. So in our world, I talked about logistics, we're seeing 20% online sales growth globally, and we're seeing obviously much lower rates. And it definitely makes you more excited on balance on logistics than it does on retail. Now, do I believe all retail?
You're saying that to me?
Yeah. And I'm not saying all retail's going away, but there's clearly this share shift. I was having lunch with my youngest daughter, who's 13 on Sunday, and I wanted to get some running gloves. And I was saying to her afterwards, you know, should we go to Modell's, Lululemon, where should we go? And she looked at me, she's like, what are you talking about? She pulls out her phone. She's like, here are 7 choices, like this. And I think to underestimate that is a mistake.
Okay, China.
So China, I would say long-term, very long on China. I think betting against Chinese entrepreneurship, the infrastructure, the spirit there is a mistake. Okay. But I would say in the short term, because a lot of sectors of real estate have a fair amount of supply and cap rates are low, it's a little more challenging place to invest.
Okay, now what about Canada?
Canada. I will say Canada, I'm very positive on Canada. The negatives on Canada are that cap rates are low and there's tons of capital here and there's obviously no distress. The positive things about Canada is you have some great cities that have this tech creativity vibe, and you have lots of in-migration. I think a better national immigration story like Australia does. Australia is even better in that regard. And that urbanization that's happening, that technology, particularly in Vancouver and Toronto, but also Montreal, is very positive. So I would like to do more here. It's just a very competitive market.
So it's Spain and Italy. What do you say about that? Both of them.
So Spain and Italy, I would say those are 2 markets we like a lot. There are not many pockets of distress in the world. We just bought a very large portfolio of residential assets in Spain. We've been by far the biggest buyer there. The story in Spain is home prices fell 40%, new construction's fallen 95%. Spain is sort of the Florida of Europe. I think Spain will come back in a big way. So big thumbs up on Spain.
Okay, and what about France?
France, we like France. I think the election there was very positive. Europe overall is doing better. There's not the kind of distressed assets that's in Spain or Italy. It has challenges. It hasn't reformed its economy yet in the same way as some of the other countries. But we like it. But I would say, you know, it's funny, we talk about countries. A lot of this we should probably be talking a little more about cities. So Paris, where you have a big stake, we did a big joint deal with Justina there. I would say very positive view on Paris. Secondary France is much tougher.
Okay, one last one, Brazil.
Brazil. So Brazil's probably been the market where we stubbed our toe, one of the few places that happened. We had some good early investments, and then we were a little too early. And Brazil has suffered from high inflation, a currency that depreciated, a really tough economic period, 3 years of negative growth. I think Brazil's at the point at which it's turning a corner, and I think the non-performing loan space in Brazil would be interesting.
So I have a fiduciary responsibility here. I've seen you interview a lot of people at your LP meetings, including David Cameron, the most recently, where you asked them at the end if they could do one word association things. Where the first thing you said to Cameron was Brexit. So that's the first word for you, Brexit. One word.
One word.
One word.
I wish it didn't happen. Is that that's
too
many words?
We get the
Yes.
point. We get the point. Diversity.
I think it's critically important.
That's a lot of words.
Sorry.
Climate.
Long-term concern.
Trump. Merkel.
Merkel. A lot of respect.
NAFTA.
I hope it holds together.
Amazon.
Powerful.
The Chicago Bulls.
I wish Jordan was there.
That's a lot of words. Daughters.
The best.
Infrastructure.
Investment.
Roger Federer.
Amazing.
Work-life balance. I'm listening carefully. Work-life balance.
Very, very difficult.
Oh, he's so honest. Hero.
Hero. Abraham Lincoln.
That's two great words. Mentor.
John Schreiber. He was the co-founder of our real estate business.
Why don't you tell the John Schreiber story?
John was a guy
yeah.
who helped build a business in Chicago, JMB Real Estate, and retired in 1990. And Pete and Steve coaxed him to part-time found our real estate business. And he stayed in Chicago, but part-time was really never part of his vocabulary.
He's a great man.
Great man, retired a few years ago. And what was great about John, I mean, he worked really hard. He trained all of us to how to be really disciplined and thoughtful investors, really independent. But best of all, he was a really decent person, is a really decent person, and it created a wonderful culture for us.
I remember you saying that he was the best third base coach in America.
Yes,
that was the
best.
Okay, John, listen, we only have a couple of minutes left, so I wanted to ask you something about that I think I would be remiss if I didn't ask you. You're not a politician. I don't even think people could guess what political party you're in. You've never been interested in politics. And all of a sudden, one time last year, your phone rings. And why don't you tell the story? Because I know it was a shocker.
Yeah, so I got a call from the folks in the Trump administration. I guess at that point they'd just been elected. Would I be open to being considered for Treasury Secretary in the U.S., which was an odd call given that I'm a Democrat and I had actually supported Hillary actively in the campaign. But I did go down to Bedminster, New Jersey, where the president had his club, and I got to meet with him and spend a bunch of time with him and his senior advisors, and it was a fascinating discussion. I'm not going to talk about what we discussed, but I will say, which is relevant for today, the biggest takeaway was just how focused he personally was on accelerating growth.
Yeah.
That was his number one thing, and it leads me to believe that they will move heaven and earth to try to get this tax bill passed. And so it's not going to be easy in the U.S. Senate and House. They didn't have success on health care, but I think they will push awfully hard. And that will have a big effect for all of us in the room, because I think it will be an accelerant. At the same time, it'll increase the U.S. deficit. It will probably make the Fed more aggressive on the rate side and could push us higher growth.
Last
higher
question.
rates.
I just want to ask
Yes.
you about the Gray Foundation, because
Yes.
I know it's important to you.
Yes.
And what I find really interesting is that you're applying the same principles that you have applied at Blackstone to charitable work. So do you want to just for 30 seconds just tell us about it?
So I've been incredibly fortunate. I love what I do and have been able to get resources. And one of the things I recognize, my wife does too, that at the end of the day, it's not going to say on your tombstone, generated high IRRs, right? So the question is, what can you do during your time to make a difference? And we set up a foundation. We put one of our very good friends, a talented woman, in charge of this. And we decided we'd focus on a couple things, basically thematic investing. One is around a genetic cancer mutation, the BRCA gene, which Angelina Jolie has. My wife lost her sister to this, to ovarian cancer. And we set up a center of Penn all around this, and really making terrific progress. We support other institutions around the world. We actually honored one of the scientists here in Toronto last year at our Bassar Symposium. It's called the Bassar Center. The second area is low-income kids in New York City. Education, healthcare opportunity, all around helping low-income kids. We've set up a children's savings program working with the city. We're building health clinics in schools in the South Bronx. We partner with cultural institutions to do all sorts of things to engage kids. So the same basic idea, which is get a great management team, leaders in these cases of these different philanthropic activities, then give them a bunch of resources and be highly focused. We're hopeful we can have a difference.
Hey, John, we're out of time. Thank you so much for taking the time to come up here. And ladies and gentlemen, John Gray.
Thank you all so much. Thank you, Daniel. Thank you. Thank you so
You're a
much.
good man.
Thank you.
Good.
Thank you.
Thank you for coming.